Hello, friends. The case on unique enterprises is already with you, and we hope you have analyzed it. Here we present our own analysis of the case. Let me begin by saying that there are two approaches to managing working capital. The first one is known as the conventional or the structural approach. Under this approach, the need for working funds is based on the estimated investment or average investment in each of the components of working capital, that is cash, accounts receivable, bills receivable, inventory, and so on and so forth. So this approach can work quite well if the conditions under which business is operating are stable. But as you know, the environment under which business operates today on the whole is not very stable. Moreover, many of the enterprises today have tended to become technology-oriented. With these developments, the limitations of the conventional approach begin to be realized. Another approach which has been tried with greater success and which has become quite popular over the recent past is known as the operating cycle approach. This approach views the working capital as a function of the volume of operating expenses. The working capital under this approach is determined by the duration of operating cycle and the operating expenses needed for completing one operating cycle. The optimum level of investment in working capital is the amount that would be needed for various operating expenses in the course of one operating cycle. The duration of the operating cycle consists of 4 stages, and it commences with the acquisition of raw material and ends with the realization of proceeds from the sundry debtors. To be more specific, the operating cycle has 4 stages. They are like this. The first stage in the operating cycle, or the length of the operating cycle, is the length of time the raw material remain in stock before they are issued to production. Let us call this D1. The second stage of the operating cycle is concerned with the conversion of raw material into finished products. And this is concerned with the production cycle, that is the time taken during the production process. Let us call it D2. The third stage is concerned with the time during which the finished products remain in stock before they are sold to customers. That is, the finished products have to wait before the sales actually materialize. Let us call this D3. The fourth stage is about the average time taken by debtors to pay off their claims. It is common practice these days for the firms to sell their goods on credit. The length of this period would depend upon the terms of credit extended by the firm and other factors. Let us call this duration as D4. Just as a business firm extends credit to its customers, it may also get the benefit of credit extended to it by the suppliers of raw materials, components, and parts. This period of credit availed of has to be deducted from the duration of the operating cycle arrived at by aggregating the time taken in the previous 4 stages. Let this period of credit availed of be known as D5. The operating cycle then would be the sum of D1, D2, D3, D4 minus D5. For analyzing the case, let us pose to ourselves some questions. Question number 1. What is the duration of operating cycle, or what is the operating cycle for the 2 units, namely UCL and DML? Question number 2. What is the amount of working capital needed for the 2 units as per their operating cycles? Keeping the amount of working capital so determined, whether the existing level of working capital deployed in the 2 units is in excess or short. Question number 3. And lastly, what advice or suggestions should be given to the 2 units in the light of the analysis? In order to answer the first question, that is the duration of the operating cycle, we have to make certain calculations or computations on the basis of the information supplied in Exhibit 1. This we will do one by one. Let us first take D1, which is the number of days raw materials remain in stock, and for this we have to work out two figures. Number one, the yearly consumption of raw materials, and number two, the average stock of materials during the year. The yearly consumption of raw materials would be equal to the opening stock plus purchases minus closing stock, and the figures for UCL are 65 plus 244 minus 72 is equal to 237. Similarly, the figures for DML is 46. The daily consumption would be this figure divided by 365. So it is 0.65 for UCL and 0.125 for DML. The average stock of materials during the year would be equal to the opening stock plus closing stock divided by 2, and the figures for UCL are 65 plus 72 divided by 2 is equal to 58.5. Similarly, the figure for DML is 7. Hence, the number of days raw materials remain in stock before they are issued to production would be equal to the average stock of raw material divided by daily consumption. Therefore, D1 for UCL would be 105 days approximately, and for DML it would be 56 days approximately. Now we take up D2, which is the average conversion period, and for this we have to work out first the cost of finished goods in the year, and this would be equal to the opening stock of work in progress plus raw material consumed plus manufacturing expenses plus excise duty minus closing stock of work in progress. And the figures for UCL are 16 plus 237 plus 143 plus 59 minus 18 is equal to 447. And the figure for DML would be 77. So the daily cost of work in progress would be this figure of 447 for UCL divided by 365 days. That is the number of days in the year. And the figure would be 1.23 for UCL, and it would be 0.21 for DML. Now we work out the second figure, which is the average stock of work in progress during the year, and this would be equal to the opening stock plus closing stock divided by 2, and the figures for UCL are 16 plus 18 divided by 2 is equal to 17. And in a similar fashion, the figure for DML would be 1. Hence, the average conversion time required would be equal to the average stock of work in progress divided by daily cost of work in progress, and the figures are 17 divided by 1.23. Therefore, D2 for UCL would be 14 days, and in a similar way, the D2 for DML would be 5 days approximately. Now, D3, as you know, is the time for which finished goods remain in stock before they are actually sold. And for this, we have first to work out the cost of finished goods sold during the year. This would be equal to the opening stock of finished goods plus cost of work in progress transferred as finished goods plus distribution, selling, and administrative expenses minus closing stock of finished goods. And the figure for UCL would be 487, and it is 81 for DML. The daily cost of finished goods sold would be equal to 487 divided by the number of days in the year, which is 365, and hence the figure would be 1.34 for UCL, and it is 0.22 for DML. The second figure that we have to work out is the average stock of finished goods during the year, and this would be equal to the opening stock plus closing stock divided by 2, and the figure for UCL is 33, and it is 5.5 for DML. Hence, the number of days finished goods remain in stock before they were actually sold would be equal to this figure divided by this figure, that is the average stock of finished goods during the year divided by daily cost of finished goods sold. So D3 for UCL would be 25 days, and for DML it is the same figure, that is 25 days. Now we have to work out the average collection period, which is D4, and for this we have first to know the sales during the year, and and the figures for UCL and DML are 673 respectively. Hence, the daily sales would be 1.65 for UCL and 0.2 for DML. The average debtors during the year would be equal to the opening balance plus closing balance divided by 2, and the figure for UCL would be 26.5 and 4 for DML. Hence, the average collection period would be equal to the average debtors during the year divided by daily sales, and therefore D4 for UCL would be 16 days and for DML it would be 20 days. Having calculated all the 4 Ds, and since we already know D5, which is the average period of credit availed of by the firm from its suppliers, we are in a position to figure out the OC, that is the operating cycle, which would be equal to D1 plus D2 plus D3 plus D4 minus D5, and the figures for UCL are 105 plus 14 plus 25 plus 16 minus 55. So the operating cycle for UCL would be equal to 105 days, and similarly the figure for DML would be 51 days. Now we can work out the turnover for the 2 units. The working capital turnover is equal to the number of operating cycles in a year, and this we can work out by dividing the number of days in a year with the operating cycle. So the figure for UCL would be 3.48 and it is 7.16 for DML. Having done all this, we can now tabulate the operating expenses incurred during the course of the year other than depreciation. We do not consider depreciation because it is a non-cash item of operating costs. Since we intend to do our analysis in 2 stages, that is stage 1 and stage 2, pertaining to the years 1986 and 87, let us for the time being confine ourselves to 1986. So first we list all the expenses: raw material consumed during the year, finished goods purchased, manufacturing expenses, excise duty, distribution, selling and administrative expenses. The respective figures are 237, 7, 143, 69, 38, and the total is 494. Similarly, the total for DML is 82. Now we can find out the working capital needed for one operating cycle, and this we can do by dividing the total of the operating expenses by the working capital turnover. So for UCL, it would be 494 divided by 3.48. So the working capital for one operating cycle, according to the operating cycle approach, would be 142 for UCL, and it would be 11.45 for DML. With these calculations at hand, in fact, we have already answered question number 1 and first part of question number 2. As already indicated by me earlier, we propose to do this analysis in 2 stages. In stage 1, we take up analysis for 1986, and then in stage 2, we extend our analysis for 1987. The calculations show that the working capital needed for one operating cycle in UCL and DML respectively is rupees 142 million and 11 or 11.5 million. From Exhibit 1, it will be noted that the existing level of working capital in UCL and DML respectively is rupees 150 million and 10 million. Thus, it will be seen that whereas UCL is having excess working capital to the extent of rupees 8 million, the working capital in DML is short by rupees 1 or 1.5 million. In other words, the deployment of working capital in UCL is in excess by 6%, and it is short by 9% in DML. It needs to be noted that both the situations, that is excess working capital and inadequate working capital, are undesirable and should be avoided. Excess working capital means a part of the funds remain idle. While idle funds do not earn, cost in the form of interest has to be incurred. This ultimately has an adverse impact on the profitability of the enterprise. Besides, excessive working capital also leads to several losses and wastages. Some examples that can be cited in this context are accumulation of inventories, select collection of receivables, losses taking place in the stores department on account of mishandling, pilferage, etc. On the other hand, inadequate working capital means carrying on business activities under constant threat or under an environment of tension. Due to shortage of working capital, the enterprise may not be able to avail of the opportunities that come its way. At times, it may not be able to meet its commitments to creditors or for other expenses. Its fixed assets or fixed facilities may remain underutilized. Any of these happenings again has a staggering effect on the profitability of the enterprise. Some of you perhaps might be thinking that since DML has been able to manage its affairs with rupees 10 billion of working capital as against its need for rupees 11 or 11.5 million, it is an indication of efficiency on the part of the unit in managing its working capital. As such, the unit should be complimented. But this optimism needs to be guarded a little. Managing a business enterprise with less working capital is possible if the unit's management is able to reduce its overall operating cycle. In our calculations, we had proposed to follow the average approach. It is quite possible that any one or more of the 4 Ds, that is the period for which raw material remains in stock, the conversion time, the period for which finished products remain in stock before they are sold, and the average collection period might have been reduced toward the later part of the year, which the average calculations are unable to reveal by their very nature. In other words, this fact might have been submerged in the average calculations. If the management has played any part in reducing any of these 4 Ds, which has the effect of reducing the overall operating cycle, then it really deserves to be complimented. However, if this proposition is not correct, then it can be construed that shortage of working capital has been standing in the way of its operations. Unfortunately, the latter proposition appears to be correct, because whereas the cost of goods sold is rupees 81 million, the sales is only rupees 73 million. This clearly shows that the shortage of working capital has been standing in the way of its profitable operations. This is supported by the fact that whereas working capital works out to 25% in the case of UCL, it is only 14% in the case of DML. Hence, working funds need to be suitably enhanced in the case of DML by rupees 1 million or 1.5 million. Earlier, we had calculated D3, which is the period for which finished products remain in stock before they are sold. This, in other words, is nothing but the inventory holding period. Now, this can be calculated in 2 steps. In step 1, we calculate the inventory turnover ratio, which can be calculated as shown in this chart. Inventory turnover ratio is equal to cost of goods sold divided by average inventory of finished goods. For UCL, it is 487 divided by 83, and for DML, it is 81 divided by 5.5. So, the inventory turnover ratio is 14.75 or 15 approximately for UCL, and 14.72 or again 15 approximately for DML. In step 2, we calculate inventory holding period, which is equal to the number of days in a year divided by inventory turnover ratio. So, the ratio is 24.75 or 25 approximately for both units. D4 is the average collection period. In a similar way, we can calculate this ratio in 2 steps. In step 1, we calculate debtors turnover ratio, which is equal to turnover, that is credit sales divided by average debtors. So for UCL, it would be 600 divided by 26.5, and for DML, it would be 73 divided by 4. So the ratio works out to 22.64 for UCL and 18.25 for DML. Then in step 2, we calculate the debt collection period, which is equal to the number of days in a year divided by debtors turnover ratio. So it works out to 16 days approximately for UCL and 20 days for DML. You will see that the computations arrived at are exactly identical to the figures obtained for D3 and 4 earlier. Having answered the first two questions, we can now take up the third question, which is the advice or suggestions to be given to the two units. Since we are in the first stage of our analysis, we do not take into account the sales increase by 20% and the inflation factor of 10%. In the first instance, we take up the advice or suggestions to be given to the UCL. The unit should be asked to manage its operations within the working capital limits of rupees 142 million as indicated by the operating cycle approach. It would therefore be asked to surrender or release the excess working capital of rupees 8 million. Secondly, the need for working capital can be reduced to a significant extent if the unit is able to reduce its overall operating cycle. The operating cycle of 105 days rather appears to be on the high side. A careful study of the various components of operating cycle, that is D1, D2, D3 and D4, would reveal that whereas D2, D3, D4 appear to be okay, D1, that is a waiting period for raw material to be issued to production, is rather too long. The overstocking of raw material is therefore unwarranted unless required by the unique circumstances of this unit. The raw material remain in stock for a good number of 105 days. This period of 105 days is against the background of availability of raw material on credit for 55 days. If the unit is able to manage this waiting period within the credit period of 55 days or any period close to it, it would be able to reduce its need for working capital substantially. As far DML is concerned, its working funds should be augmented by rupees 1 million. With this working capital constraint now removed, the unit should be impressed upon the need for showing profits. Secondly, here too, against the average conversion period of 5 days, the raw materials remain in store for 56 days, that is 11 times more. It should be emphasized upon the unit to curtail this waiting period of 56 days. In this way, the unit will be able to economize on the need for working capital. Maybe the unit is able to manage within the existing level of rupees 10 million comfortably. Now we introduce in our analysis the projected changes, that is the higher sales level of 20% compared to the level of 1986 and the inflation factor of 10%. With this, the operating expenses that we had calculated earlier will change. In view of the projected changes for the year 1987, level of certain expenses will increase. The raw material cost, the finished goods cost, the manufacturing expenses cost would increase by the respective figures. That is, we have to increase all these three figures first by 20% and then the resultant figures again by 10% for providing for inflation factor. Since the higher sales target would also lead to a higher volume of production, so we have to provide for 20% for the excise duty. That is, the excise duty amount will be raised by 20%. Assuming that distribution, selling and administrative expenses are fixed costs, you see, they would not change. So the total of the operating expenses for UCL and DML will be 632 million and 103 million respectively. Dividing these figures by the operating cycle turnover, the working capital needed for UCL will be 181.60 billion and for DML it will be 14.39 billion. Hence, A further working capital of rupees 31.60 billion and rupees 4.39 million will have to be made available to UCL and GML respectively. This concludes our analysis of the case on unique enterprises. If you still have any doubts, you may consult your counselor for clarification.